And start.
Hello. Yeah. Good evening and welcome you all today's webinar on the topic concept of residency and place of effective management. This is Bhamini GSCA here, and I would be the moderator for today's session. The session is hosted by the Direct Tax Committee of the ICAI. Before we move on to the session and the speaker introduction, let me welcome Mr. S.P. Singh, sir, ex-IRS officer, who is the guiding force for the committee for several years now. S.P. Singh, sir, was with the Indian Revenue Service for more than 2 decades. He held various positions, including Director of Income Tax, International Taxation, and Commissioner of Income Tax Appeals. He participated in negotiations of tax treaties with more than 30 countries and took part in mutual agreement procedures. He has represented India in several international conferences and presented papers. He was a member of the expert group on transfer pricing constituted by the Ministry of Finance for drafting the transfer pricing regulations. He represented the Income Tax Department before the Authority of Advance Rulings in several cases. Over to you, sir, for today overview of the today's topic of residency and poem.
Thank you, Bhamini, for nice introduction. Thanks a lot. And good evening to all the participants. Welcome to this webcast. It's always a privilege to be in the webcast organized by the DTC, whether for international taxation or for the income tax as such. It's always a learning, and when we have a speaker like Nilesh, you are always benefited at the end of the day. And the questions which are put by you add to the knowledge of the speakers, moderator, and all the people present. So be proactive, put the questions wherever you have doubt. If there is anything which left, then in that write to DTC, and then the secretariat will come back to you. The today's topic is very interesting and very fundamental, I would say. The concept of residence and point. When you look at any tax law, it's not only income tax, but any tax law, it stands on 3 legs: Brahma, Vishnu. So it's a trinity. I mean, just any thought, who, what, how. So who is to be taxed? What is to be taxed? And how is to be taxed? There cannot be a better way of introducing this other than talk section 4. It's a beautiful section. Let me read out for 1 minute and we'll go on further discussion. Now, this section says, when any central act enacts that income tax shall be charged for any assessment year at any rate or rates, income tax at rate or those rates shall be charged for that year in accordance with and subject to reasons of this act in respect of the total income of the previous year of every person. So it identifies all the three. Who is to be taxed? Every person is to be taxed. What is to be taxed? Total income is to be taxed. How is to be taxed? In accordance with the provisions of this act. Now, this is a very broad power which has been provided by the Parliament to the authorities and for the consultants to look into. But can everybody be taxed on all income? Is it possible? Is it advisable? That suppose comes, a foreigner comes, does some activities, and then earns an income. Are you going to tax his global income? Now, these are the questions which forced the policy makers to think about how horizontal and vertical equity can be achieved. And then in that, the questions which pertain to foreign entities come into play. Their taxation has to be different from the taxation of the people who are citizens or in, any other criteria which can be assigned. And that any other criteria gave rise or gave birth to the concept of the residential status. Section 6 defines what resident, who is non-resident, and in India there is not already resident. And how are their income to be taxed? Section 5 is very comprehensive, and you must read it as many times as possible. Section 4, 5, and 6 are the pillars, the three pillars of the Income Tax Act. And for that matter, these concepts are there in all tax jurisdictions with the variation. Now, when you think of, that when you introduced that, okay, uh, the resident and the non-resident, not ordinarily resident, then the burden comes on the policymaker to come up with a definition which would be dynamic. And that is why you come across the changes, amendments which are brought by year after year, the definition of not ordinarily resident, clubbing with them, with their activities, their movement, number of days of stay. At the same time, the definition should be easy to understand, should not by nature give rise to controversies. Now, in the background of these things, the definition of residence in case of individuals, which have been provided in the Income Tax Act of India, it divides into two heads. One is based upon the political allegiance, and the second one is the economic exploitation of the resources of the country. Political allegiance gives rise to the taxation or the global income. Economic exploitation is the basis for taxing only that income which arises in the hands of non-residents, and the further extension of this scope under Section 9. So this is how the tax need is decided or determined in respect of the residents and the non-residents. So not all income are to be taxed. Not everybody has to be taxed equally. It has to depend upon the circumstances, the sources of income, and the two aspects which I mentioned earlier. Now, there are, certain entities which are peculiar to India, like HUF, partnership, and then the definition has to be developed. We should define, when a HUF will be a resident or when a partnership will be a resident and things like that. The one entity which has been drawing the attention, not only in India, but across the globe, is that of the companies. Now, the definition of the residential status of a company is very, very interesting. You can divide it into two parts. One is the definition which is based more on the legal aspect. So Indian company. So or where the earlier when dividend was distributed. If the arrangement for distribution of dividend is in India, then that becomes a resident of India. That has been now done away with. The legal basis is in respect of Indian company. How Indian company, you know it better, and Rilesh will talk about those aspects. Now, there is a business basis also, and that has come into existence across the globe. The reason that there is, free flow of fund, easy movement of resources, easy movement of labor. Now that has given rise to the concept of the place of effective management. Where is being, because at the end of the day, you tax somebody where you can associate that with certain activities. And that is why the concept of place of effective management, or POEM, which Nilesh will be talking in greater detail. Now, there have been several controversies. The definition, which sound very simple, have many twists and turns when you go into the sentences and look at the practical aspect. But those are things, the decisions of the courts give rise to the development of a law. And in case of the residential status, that has actually happened. I'm not aware of case laws on the point. It's still developing. The tax authorities, the taxpayers, have to get hold of that and then apply in respect of carrying on the business. We will be listening to all these aspects in much greater detail from Nilesh. Over to you, Bhamini.
Thank you, sir, for giving us an insight and overview of today's session. You rightly said, sir, Section 4, 5, and 6 are pillars of our taxation. With this, now I welcome our speaker for this session, CA Nilesh V. Vitlani. Sir is a chartered accountant and senior partner practicing in Hyderabad. He specializes in income tax and GST. He has over 33 years of experience in handling complex income tax and GST matters, including scrutiny assessments, survey, and search matters before various authorities up to the appellate tribunal stage. He has rich experience in handling tax matters of retail industry, software companies, expert-oriented units, construction companies, service industry, and startups. He has presented papers on various topics on income tax, international taxation, and goods and service tax at various forums across the country. He is a regular speaker at the diploma course on international taxation conducted by ICAI. Sir is also a past chairman of the International Fiscal Association Hyderabad subchapter. He is presently on the core team of the Hyderabad study group of the Chamber of Tax Consultants. Thank you, Nilesh, sir, for accepting this invite, for being the speaker for today's session. And sir, the floor is all yours.
Thank you, Bhamini. So at the outset, I would like to thank the Direct Tax Committee for giving me this opportunity of making a presentation on this topic, which has been close to my heart, I would say, and academically, as well as we have been having issues. So the best way to learn is to teach, is what I believe in. And I'm truly blessed that we have Mr. S.P. Singh chairing this session, and it's a privilege to be speaking on this occasion, sharing the platform with him. With this, let us start with the presentation. Today's topic, concept of residence and place of effective management. Residence we will be just touching in brief. We'll be more focusing on the place of effective management. So this is the agenda for today. Brief understanding of Section 6 itself, residence in India, the tests for residence in India. As Mr. Singh mentioned, Section 5 defines the scope. Section 4 is the charging section. Section 5 gives us the scope of total income. And Section 6 is the test of residence in India. There, we have status-wise determination of formulas given various how to test residency in India, for which control and management is a phrase being used quite frequently. So we'll have a close look at what do we mean by control and management. And finally, as mentioned, for companies, it is the place of effective management since 1st April 17. So we'll look at the concept of that place of effective management in the third law. You must all have read Section 6 quite a few times, but it's always better to revisit again. So Section 6, subsection 1 deals with individuals. It says an individual is resident in India in any previous year if he either has A or B. There are two conditions which are alternate conditions. The first condition being is in India in that year for 182 days or more. So close to 6 months in a year or more, if he's in India, he becomes a resident. He doesn't have to go to the second condition. If his stay in India is less than 182 days, then we have to test the second condition. Having within 4 years preceding that year been in India for 365 days or more and is in India for 60 days or more in that year. So this second condition also has two sub-conditions. First, we have to check the preceding 4 years, whether the person has stayed in India for more than 365 days in those 4 years. And the second limb, 60 days or more in that particular year. So we are actually looking at block of 5 years. 4 years, test whether it is 365 days. So roughly 25% of the time he has spent physically in the country. And during the same year where we are testing that residence, in that year, it has to be 60 days in that year. So 1/6 of a year. For certain situations where a citizen of India, certain leverages are given, certain relief is given from that condition of 60 days. The second limb of the second condition, 60 days, is given a little more time for a person who is a citizen of India. What are those three conditions? He leaves India as a member of a crew of an Indian ship for the purpose of employment outside India. Then, in the year in which he is leaving, the instead of 60 days, you count 182 days. So the first condition remains the same, 365 days or more in the preceding 4 years, plus 182 days in place of 60 days during that particular year. Second, a person of Indian origin, that is a citizen of India or a person of Indian origin, returns to India in any previous year. In that case, also the same conditions will apply. That is 365 days out of 4 years, preceding 4 years, and 182 days in that particular year instead of 60 days. So a person of Indian origin returning to India and staying in India for the first time in last 5 years and coming in India and staying for 181 days, he would still be a non-resident. The third category, if such a person has Indian total income, that is not foreign income, but Indian income arising out of India of more than 15 lakhs, then instead of 60 days, it will become 120 days. That is 365 days out of four preceding previous years and 120 days during that year. As you recall, this was brought in to plug the loophole of double non-taxation. Then we come to subsection 1A. Notwithstanding anything contained in 1 above. So this subsection prevails over the subsection 1, what we have seen just now. A citizen of India who is otherwise non-resident under above, having Indian total income of more than 15 lakhs, shall be deemed to be a resident in that previous year if he is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria or similar nature. So this is again that amendment which was brought in. For example, in the UAE, there was no personal income tax. So a person who has been working in the UAE comes back to India and stays for, it sort of is non-resident under the first category, but has more than 15 lakh income in India, he will be deemed to be a resident of India, although he may not satisfy the conditions given in subsection 1. Subsection 2 of section 6 deals with HUFs, firms, and associations of persons. By default, these three categories are deemed to be resident, except when the control or management of its affairs is situated wholly outside India. So what do we mean by this? Let's say a karta of an HUF is staying abroad and he is controlling and managing the HUF funds, the corpus of the HUF from abroad, then the HUF would be non-resident. But if he is in India and maybe spends a few days in a year managing the corpus of the HUF, then that would be treated as a resident. So here there are no conditions as regards to number of days stay, but it is purely control and management. What we mean by control and management, we'll see in the subsequent slides. Similarly, a partners or a majority of partners, if they are controlling the business of the firm wholly outside India, then it would be a non-resident. Lest it would be resident. What it means is, even if it is partially being controlled from India, that firm could be a resident of India. Same way, the AOP will have to look at the top person, let's say it's a trust, the managing trustee or something like of that sort, the top executive of the AOP, whether or the body which is managing the AOP funds or corpus will have to be tested whether they have the control and management. They are exercising the control or management wholly outside India. If not, that AOP will become a resident. That leads us to section 6.3, which deals with a company. As Mr. Singh has already mentioned, for a company, there are two tests. One is related to the place of registration. If it's an Indian company, without any further ado, it becomes a resident of India. So what it means is the second condition will apply only to foreign companies. So in respect of foreign companies, what we need to look at is the place of effective management in that year is in India. So I'll read it again. A company is said to be a resident in India if one, it is an Indian company, or two, its place of effective management in that year is in India. What do we mean by place of effective management? That has been defined. The explanation below 6.3 gives us this definition. For the purposes of this clause, place of effective management means a place where key management and commercial decisions. So, key management and commercial decisions that are necessary for the conduct of business of an entity as a whole are in substance made. So, place of effective management is the place where the management and commercial decisions, which are key to the business as a whole, for the conduct of the business as a whole, as the entity as a whole, are in substance made. So, very fluid, very dynamic, again, as Mr. Singh mentioned, and purposefully, I would say, is kept like that. More importantly, place of effective management is a concept which has been borrowed from the DTAS. So we'll look at this definition in more detail in the subsequent slides. Now, before we go to POEM per se, what do we mean by company? Because this section 6.3 applies to a company. Now, company has been defined in the Income Tax Act in 217. It says an Indian company or any body corporate incorporated by or under the laws of a country outside India, or any institution, association, or body which is or was assessable as a company under the Indian Income Tax Act 1922 or this act for any assessment year commencing on or before 1470, or any institution, association, or body, whether incorporated or not, and whether Indian or non-Indian, which is declared by general or special order of the board to be a company for the specified years. So it's not simply set a company, but we have to look at whether a enterprise or an entity is defined as a body corporate under the laws under which it has been incorporated outside India. So let's take an example of LLC. US and few other countries have this concept of limited liability corporation. We need to test whether that LLC is considered as a body corporate under the respective law, the US or the other country's law, then it would be a company for the purpose of 217. Is it material? Yes, because whether POM applies or the general term of control and management applies would be the determining factor, or the subsequent, there's a residual clause as well, whether that would apply. So that is why the definition of company is very important when we are testing a foreign enterprise, foreign entity, as whether it is a company or not. We'll need to look at the respective domestic law of incorporation. For the other types of SSEs, that is the residual section 6.4. Others will be resident in India in any previous year in every case except where during that year the control and management of his affairs is situated wholly outside India. So very similar to HUFs and AOPs and firms. If a part of the control and management of the affairs of that enterprise entity is in India, it would be resident. This is source-wise. Section 6.5 says that if for a particular source it has been determined to be a resident in India, then it shall apply to other sources as well. Just to summarize what we have understood till now, based on status, the test of residency will be different. For an individual, it is pure and simple number of days, 182 days, or the subsequent conditions. Subsequent conditions based on citizenship or person of Indian origin, then there are certain different conditions. Otherwise, for a foreign citizen, it would be different. HUF, firm, and AOP, but very coming back to individuals, it is very clear and objective, unlike the other tests where it is more of subjective factors which come in. So HF, firm, and AOP, we have to look at control and management. It should be wholly outside India to be non-resident. If it is not wholly outside India, it becomes a resident. Company, it has to be an Indian company, or in case of foreign company, place of effective management is in India. For others, similar to HF and firms, control and management not wholly outside India. So that clears section 6. Now let us look at what do we mean by control and management, because it has relevance for 4 types: HF, firms, AOPs, and others. In fact, companies also had that phrase used up to 1st April 17, or till 31st March 17, which said section 6.3 then read as a company is said to be a resident in India if it is an Indian company, or during that year, control and management of its affairs is situated wholly in India. So this was the phrase applicable till 31st of March 17. This was replaced with POEM from 1st April. So what has happened? From 1st of April, the first condition remains: a company is said to be a resident in India if it is an Indian company, or 2, its place of effective management in that year is in India. So if you see, the phrase control and management has been replaced with place of effective management, and it used to be wholly in India. That phrase has not been put. So we'll understand the significance in the subsequent slides. So this was not the thought of the government only in 17. It has its own history. 2009 Direct Tax Code Bill also had the phrase control and management, but it was very stringent. It was a narrow definition which could capture a lot of foreign companies to be taxed in India. Foreign companies were proposed to be treated as resident in India if their place of control and management at any time, this is the phrase, at any time during the year is situated wholly or partly in India. So wide spectrum which could capture a lot of foreign companies uh, to be taxed in India under the proposed direct tax code bill. Place of control and management at any time during the year is situated wholly or partly in India. So probably one board meeting being conducted in India would have triggered a residential status for the foreign. What do we mean by control and management in general terms? It means controlling and directing power, the power to control and direct the business of a company. The head and brain. This phrase has been used quite often in the international tax arena. The head and brain will determine what the place of effective management is. The head and brain of the company. Decisions of vital policies, not the day-to-day routine decisions, but decisions of vital policy making. Control and management is a composite test to be considered jointly, not severally, because of the use of the word is. If you see in the definition, a company is said to be a resident in India, the previous definition. During that year, the control and management of its affairs is situated wholly in India, not are situated wholly in India. So what it means is the control and management phrase has to be counted as one single phrase. It's not only control, not only management, but both control and management, both of them have to be tested for a company. For example, what are the decisions which we are talking about? Expansion or contraction of the business or territories, going into new countries to expand, extension of new activities. I'm in product A, I'm adding product B. That decision, when whichever body is taking, that body, wherever it's meeting, that place would be the place of effective control and management. Raising of finances. Where are the decisions for raising of finances being taken? Appropriation of finances to specific purposes. Those funds, where are they being I mean, where to apply them? What are those decisions and when are they taken? Which place are those decisions being taken by whom? So those bodies and those places would be counted as control and management, exercising control and management. Appointment and removal of top management. These decisions, which body takes those, that body would be the controlling and the managing body. Typically, in the case of an HF, very easy, Karta is the only person who takes the calls the shots. So that would be the person. Senior partners or a majority of the partners if it is a firm, and principal officer of an AOP. We need to look at the activities being carried out by these people and their location at the time of taking those decisions would determine the control and management. Registration of the foreign enterprise is irrelevant. If it's an Indian company, we have seen it by definition it becomes an Indian resident. But if it is a foreign enterprise, registration is not relevant at all. Being merely registered in the US doesn't make it a US resident because the control and management could be from India. So, in that sense, this concept of control and management is an exception to the rule of place of incorporation and sort of an anti-abuse measure. It should be central and effective management, de jure as well as de facto. That is, in principle as well as in practice, the central and effective management should be vested with that body. However, not shareholders' control. So, as we understand, the company has the shareholders and the board of directors. As a body of shareholders, there are certain powers, but running of the business is vested. The powers to take calls on running of the business is vested with the board of directors. So, the body of shareholders cannot determine the place of residence or the control and management of the company itself. So, it may or may not, it is not like by default, like we have seen, place of registration is not relevant. Even the location of the shareholders is not relevant because shareholders control is normally linked to the registered place. Only when in liquidation would a company be said to be under the control and management of the liquidator. Only in such a circumstance would the liquidator's location be the place where the control and management is being exercised. So we had a brief understanding of Section 6 and what we mean by control and management. So now let us look at some case studies. So these are actually based on certain judgments. So facts of this case are a firm has three partners, which is carrying on business in South Africa. One of the partners visits India, leaving the management of the business with the other two partners. While in India, the said partner remained in touch with the other two partners. The latter two partners informed the former about the general conditions of the trade. He, from time to time, that is the first partner, from time to time, cautioned the latter two. Now, whether this would amount to control and management by that partner who is in India, the decision of Bhimji R. Nayak said no, the control and management was not in India because the majority of the partners are there still outside India. So, in fact, one of them was in Malaysia, not even. So, one was in South Africa, while the first one was in India. The third partner was in Malaysia. That didn't matter. The point was we are looking from the Indian perspective. In India, only one third of the partners were residing, and moreover, he was not exercising the control and management in the strict sense. He was only taking feedback and sort of stopping at that. He would just caution once in a while. That doesn't amount to control and management. And based on those facts, it was held that there was no control and management in India in respect of that firm. So that firm was non-resident. Another case study, firm originally assessed as non-resident. The managing partner was in India uh, for 1 year and 2 months for purely personal reasons. The other two partners, B and C, were Indian residents. Before leaving for India, A had appointed an agent to manage the affairs of the business with all the powers which he enjoyed under the partnership deal. He appointed an agent. He delegated all his powers to that agent. Reassessment proceedings were initiated to tax the firm as a resident. What was held? Mere presence of MD in India would not lead to the inference that control and management was in India. So here, what is the crucial point is that although he was the only partner, the minority partner who had been managing the business, this was in Ceylon, Sri Lanka then. I mean, Ceylon then, Sri Lanka. So the firm was carrying on some estate business, some plantation business in Ceylon. Two partners were already in India. This partner, the third partner, was the person already conducting the managing the business there alone. It was in the past treated as non-resident. That firm was treated as a non-resident or in India. For 1 year and 2 months, that partner who was the managing partner came down to India. So what it meant was all three partners were in India. But before coming here, the managing partner had delegated all his powers under the deed to an agent who was acting independently. And because of those facts, it was held that the firm was still non-resident, although all the three partners were resident in India. So this is a very good example of how control and management is crucial and not the owners. The partners here were merely owners. The actual activity of the board of directors or the top executive of the firm, the decision making of the three partners was delegated to a person who was non-resident, who was acting, who was operating from Sri Lanka. So it was held that the firm, which was uh, from Sri Lanka, did not become a resident of India. This is held in Chitra CIT versus Chitra Palayarkar Company, Madras High Court decision. Other issues, HF Karta is the sole authority to take decisions. Presence of Karta in India and decisions taken in India may trigger the residency rule. This we have already understood, just a reiteration. So a person, HF, visits India. Let's say he has let out properties in India. He comes to India and sort of changes the tenants or talks about the increment of rent and so on. So those decisions, if they are taken while he is in India, it would amount that the HF is being controlled and managed from India. Because even a partial control and management in India during a year is enough to trigger the residency rule. Similarly, AOP, principal officer, we have to see what and where his decisions are being taken. If there are multiple people as a body, that executive body, where are those decisions being taken? Control and management is not the same as carrying on business. The day-to-day activities of the business are different. What we need to look at is the top-end management, the control and management. Supervision, supreme command versus day-to-day business operations. What we are looking at is the topmost decision-making power, supervision and supreme command, as against day-to-day business operations. So I may appoint a person outside India and he's doing the day-to-day routine work. That doesn't make that entity being controlled and managed outside India. If I am in India and I am making all the top decisions. So another case study, a Singapore company has 99% shareholding with an Indian uh, resident. She and a Singapore resident, who's that 1% shareholder, only two people are involved, are the two directors. So 99% shareholding with an Indian resident, 1% shareholding with a Singapore resident, both of them are the directors. Check signing authority with the Indian resident singly. All board meetings conducted in Singapore. No employees, no office rent being paid in Singapore. Probably whenever this lady visits there, in the hotel, they would have had meetings held. The board controlled and managed the affairs of the company, not the shareholders. So what it means is the 99% shareholder, that lady being an Indian resident is of no matter, no consequence. Because we have to look at the board of directors, not the shareholding, not the shareholders or directors individually. She alone staying in India, although holding 99% of the power, could not be counted as board. The board of directors constitutes two directors, and we have to look at where those two directors met. That was happening in Singapore. So the situs of board of directors determines the place of control and management. This is an important decision of Radharani Holdings versus ADIT of 2007. I think this is the closest we come to place of effective management in terms of judgment law. So I would say this judgment will hold this way going forward as well. Very nicely put. The shareholding is different from directors. Directors individually are not relevant. As a board, where are they functioning? Although there is no office, no rent being paid in Singapore, that was not of that importance in this part. So we have the similar case, management under agreement. We saw the plantations case of Ceylon, something similar. Business being managed by an agent under specific agreement. Whether place of residence of owner would be the place of control, the answer is no. We have seen that in the past. Construction of the agreement is important. What we need to look at in such a scenario is what does the agreement talk about? Is it the day-to-day activities versus is it the top-end decision-making power? Evaluate the powers granted to the agent and exercised by him. It's not enough that they are granted, whether he or she is exercising those powers or not. What was the owner's role? Was it a passive role, sort of a shareholder's role, or was it more active? Whether the agent is a dependent person on the instructions and acts on the instructions of the owner. If so, the firm would be resident. So in this case, unlike in the earlier case, the agent was found to be acting at the behest of the owners who were resident in India. Because of that, the control and management was said to be in India. Although to look at, there was an agreement available which gave so many orders, so many powers to the agent. But in fact, in day-to-day activities, they found documents to show that all the decisions were being spoon-fed to the agent from India. And that is why that firm was said to be being controlled and managed from India and therefore resident. This case is Erin Estate, again a plantation case versus CIT. It's a Supreme Court judgment. That leads us to the third limb of today's presentation, place of effective management. This concept was first introduced in the Finance Bill of Finance Act of 1st April 2016. Then it was deferred by 1 year because there was a hue and cry. And the section itself said that they will be coming out with guidelines which were not brought out. And so it was deferred to 1/4/2017. And from that day onwards, we have had this concept of poem. What was the justification for introducing this concept in the first place in Finance Act 2016 was given in the explanatory notes. A company could easily avoid becoming a resident by simply holding a board meeting outside India. Because if you recall, the old definition was control and management only in India. That was the concept of company being a resident. So then it was very easy that any Indian company, let's say the biggest of the companies, Reliance, Larsen Tubro, if they conduct one board meeting outside India, then it can be easily said that the management and control was not wholly in India. By that, it could have escaped the rigors of residency. A company could easily avoid becoming a resident by simply holding a board meeting outside India. This facilitated creation of shell companies which were incorporated outside India but controlled from India. Right? So this was the logic behind introduction of POEM. We need to bear in mind the purpose of this legislation so that whenever we have certain doubts, we can come back to this purpose of the legislation. So we need to look at the justification to deal with cases of creation of shell companies. It was clearly stated that the fear was that a shell company created outside India and controlled from India could get away under the existing laws, pre-amendment laws. Second justification was to align domestic laws with DTAs because DTA had already all the DTAs India had signed had the concept of place of effective management. And so to ensure that there's no dichotomy there and there is a Same definition can be looked at in the domestic law. The domestic law was amended. So in that sense, the DTA definition can also be looked at in case of need to align domestic law with international standards. Not only the DTAs India had signed, but also the international standards. There were literature, huge literature available for place of effective management. It was widely accepted and understood concept. So to align the domestic law with those standards, it was amended. Well-recognized guiding principles for determination of OM. There is OECD commentary, there is UN commentary, which define place of effective management, and it has been widely understood. So there are guiding principles which are available to determine where the place of effective management is. So these were the pointers for which the amendment was brought in. Initially, when the Finance Bill 2015 was introduced, the trigger was, the condition of POM was, its place of effective management at any time in that year is in India, which was borrowed from the Direct Tax Code Bill. So what would it mean is, if one board meeting of a foreign company, a company registered in the US, conducts one board meeting in India, that even could trigger a place of effective management uh, threshold, because it says at any time during a year. The reason for dropping that phrase was explained as follows. Then in the final provisions, when the bill became an act, this phrase at any time was dropped. So it would be interesting reading why it was dropped. The justification reads as, it was proposed that a company shall be resident of India if it is an Indian company or its place of effective management at any time in that year is in India. At any time in that year. Concerns have been raised with regard to the phrase at any time, which may lead to unintended consequences, such as even one board meeting in India may make a foreign company a resident in India. I propose to drop the phrase at any time so that no ambiguity remains. So, very clearly, by this act of dropping one phrase from 15 to 16, gives us an indication of what the purpose of place of effective management should be. That mere conduct of one board meeting does not qualify as place of effective management. What is the international understanding? It has been used as a tiebreaker test. All of us know that the test of residency in the DTA has a tiebreaker test. For companies, it is place of effective management. For individuals, there's a host of list of tiebreaker tests. For company, it is only this one. Where is the place of effective management? That would be the country in which it would be treated as resident. So it aligns with Indian DTAs, place where key management and commercial decisions that are necessary for the conduct of the entity's business as a whole are in substance made. So very similar to the definition which we have in our Income Tax Act as explanation below 6.3. This is borrowed from the OECD commentary on Model Tax Convention 2017 update. But is it good enough? Let's see. The problem is the international understanding also has been evolving. Prior to this 2017 update, the definition of key place of effective management read as follows. Key management and commercial decisions that are necessary for the conduct of the entity's business as a whole are in substance made. So far, so good. This is still there. But it was followed by this phrase, and will ordinarily be the place where most senior person or group of persons, for example, a board of directors, makes its decisions, the place where the actions are to be taken by the entity as a whole are determined. So this part of that definition was dropped. This was there till 2008 update. 2008 update dropped the reference to board of directors. So what has happened is it has become more subjective. The reference to board of directors has been dropped, and perhaps rightly so, because there could be situations where the board would have delegated its most of the powers to an agent, which some cracks could be there. We already seen that judgment. So let's see what the complications are. 2017 updates way to case-by-case examination involving a mutual agreement between competent authorities. So what the 2017 update has done is it has dropped that example of board of directors and the top management and has left it to mutual agreement process between the competent authorities. What is the place of effective management in a given situation has to be decided by the two competent authorities. So it has become far more open-ended and subjective under the international OECD commentary. So, and yet there are certain factors which the commentary gives us. Factors determining POEM, POEM, para 24 to 2008 update, place where board of directors meetings are usually held, place where CEO or senior officers usually carry out their activity, place where senior day-to-day management of the corporate is carried on, location of headquarters, country by which governs the legal status, place where accounts are kept. These are the pointers given out by the OECD commentary. However, India has raised its objection to it. India's position on this clause, para 24, reads that place where main and substantial activity of the entity is carried on also to be taken into account. So India's position is that apart from the above, wherever the main and substantial activity, business activity of the enterprise entity is being carried on, also has to be recognized and taken into account. So let us revisit the explanation to 6.3. As I told you, it has been borrowed from the OECD commentary. The place of effective management means a place where, first of all, key management and commercial decisions. That is the first step or the threshold or condition to be met. That key management and commercial decisions that are necessary for the conduct of business. Necessary for conduct of business. It mean if it is something not related to business of the enterprise, it need not be entity, it need not be relevant for this purpose. Entity as a whole of business, conduct of business of an entity as a whole, not one branch, not one product line, not one of a position status or one of employee and so on. As a business entirely in its totality, what are those decisions which are being taken? That is what we need to look at. Are in substance made, not on paper, but in substance. Who are those people who are actually calling the shots, who are taking those decisions? That body, wherever it meets, is the place of effective management. If on paper agent has been appointed, but he is used to accustomed to work on the basis of instructions given by the board, again, that individual will not determine the place of effective management. So we have to look at substance. As I told you, 1417, the purpose of extending the applicability of POA by 1 year was that the guidelines were not brought out in 16. On 24th January 2017, the Circular 6 of 2017 was issued. It laid down the guiding principles. Now, mind you, it is a circular. The guiding principles for determining place of effective management was laid out in a circular. Now, as we need to look at what is the validity of a circular. So something which is against us, as long as the circular emanates from the CBDT and contains orders, instructions, or directions pertaining to proper administration of the Act, it falls well within the parameters of the powers exercisable by CBDT under Section 119 of the Act. This is from Union of India versus Azadi Bachao Andolan. Ironically, Azadi Bachao Andolan was a blessing for all Mauritius-based companies. It was talking about the circular on TRC, the tax residency certificate. So there the Supreme Court said that a circular issued by the CBDT, if it is within the four corners of the law and it is meant for proper administration of the Act, it shall be upheld. It is hitting us back at the SSC here. The place of effective management is brought out through a circular. The law says that guidelines will be issued. The circular issues those guidelines. So then it is meant for proper administration of the Act and therefore it is binding on the SSCs. But there's one catch here. We'll look at this concept going forward. There's one phrase used in the circular, which is not there in the act: active business outside India. This phrase has been used throughout the circular multiple times. In fact, we normally call it as ABOIN as an acronym: active business outside India and enterprise not having active business outside India. These are the two broad categories of entities which has been dealt in the circular. These concepts have been introduced by the circular. It has no mention in the act. This is the first time this phrase or this concept has been introduced in the circular. So then, can CBDT do so? For that, CBDT does not have the power to introduce a substantial change or alteration in the provisions of the Act by importing new ideas which are unknown to the Act. This was held by the Bombay High Court in Jalgaon District Central Cooperative Bank versus Union of India. So probably in a given circumstance, one may want to take a recourse to this, that CBDT cannot travel beyond the law itself, act itself. So by introducing this concept of active business outside India through a circular, may be taken to the Supreme Court. Only Supreme Court can now decide on it. So now let us look at what are the guiding principles which have been laid out in that Circular 6. So what it says, poem will depend on facts and circumstances of a given case. Facts are very crucial. Facts and circumstances of the case are very crucial for any test of poem. Second principle, substance over form. We will not look at the paperwork. We will have to look at the substance, where in fact the authority or the power is being exercised, and so on. There can be more than one places of management, but there can be only one place of effective management at any point of time. So what it lays down is, in a situation, there can be multiple places of management, but that does not take away anything from poem, because poem can be only one and unique. That is the presumption. Probably, again, this might be tested in certain circumstances. Poem has to be determined on year basis. It is not enough that in year one, the company was treated as a non-resident. It is not given that in year two also it would continue to do so. Again, in year two, we have to test all these guidelines or principles to test whether poem is triggered or not. Poem to be primarily based on the fact whether the company is engaged in active business outside India. The crucial test in the entire guiding principle is active business outside India. Poem will be outside India if majority of BOD meetings are held outside India. So this is one very rational, objective test which has been laid down. So what are the steps? Circular 8, February 23, 2017, one circular was issued. There was hue and cry after the Jan circular of the Circular 6 came out. There was a hue and cry that this might impact so many SSAs. So to safeguard, to sort of give a threshold, Circular 8 was introduced saying that, in fact, a press note was released first and then it was ratified through a circular in February. It said that turnover of the foreign company should be more than 50 crore rupees. If it is less than 50 crores, those entities will now never be counted as residents of India. So that was a fair and a proper thing to do and a welcome step. So whenever we are testing a given case, we have to look at whether the turnover of that foreign entity in a particular year is crossing 50 crores or not. If it is below 50 crores, you can sleep tight, no worries of poem. Step 2, active business outside India. What do we mean by this? A company shall be said to be engaged in active business outside India if the passive income is not more than 50% of its total income and less than 50% of its total assets are situated in India, and less than 50% of total number of employees are situated in India or are resident in India, and the payroll expenses incurred on such employees is less than 50% of its payroll expenditure. The above have to be calculated on an average of 3 years, the previous year itself and 2 preceding previous years. So let us look at these conditions again. What do we mean by active business outside India? First condition, passive income. We have to see what is the passive income, and that passive income should not be more than 50% of the total income. The passive income has to be 50% or less. Then that is the first test. Thereafter, these three tests, less than 50% of total assets are in India. So a majority of its assets should be located outside India. That is, 51% and above should be outside India. 50% or above should be of the assets of the company should be outside India. Less than 50% of the employees should be situated in India or residents of India. That is, more than 50% of the employees should be 50% or more of the employees should be outside India. And the payroll expenses incurred on such employees is less than 50%. So not only the number of employees, but even the payroll expenditure, that is the salary being paid to those employees should not be less than 50% of the total salary expenditure. So it's again substance over form. It is not enough that you have the number of employees more in outside India. Even the salary being paid to them should be more than 50% of the total salary package, salary expenditure. What do we mean by passive income? That's the first test here. And the first condition, passive income should be less than 50%. So what do we mean by passive income? That has been also defined. Income from transactions where both the purchase and sale of goods is from or to its associate enterprises. That is, the although it's an operative income, trading income, let's say, buying and selling happens from and to associate enterprises. That would be counted as passive income. Income by way of royalty, dividend, capital gains, interest, or rental income. All these are counted as passive income. However, one exception for banking companies, interest is excluded. However, any income by way of interest shall not be considered to be passive income in case of a company which is engaged in the business of banking or is a public financial institution, or its activities are regulated as such under applicable laws of that country of residence, country of incorporation. So only for banking and financial institutions, interest is not to be counted, but all other entities, royalty, dividend, capital gains, interest, and rental income will be counted as passive. So we had two steps. First step was less than 50, that threshold. Step two was whether there is a passive income. Then whether the assets, employees, payroll expenditure are more than 50% outside India. If we cross that threshold, then we need to evaluate the place of effective management. If the company has active business outside India, that is, if you have satisfied those tests, then primary rule, does the board stand aside? Has the board given up its powers to some other person or body? If no, poem is outside India. If the board is acting on its own, then the place of effective management is outside India. So it is not enough that you have passive income, you satisfy all these conditions, that you have active income, you have assets outside India more than 50%. You also need to ensure that the board meets outside India. And actually, board exercises the powers and outside exercises the powers, then the poem is outside India. If yes, secondary rule shall apply. That is, if the board has stood aside, it has given up its powers, then who makes the decision? We have to go behind the board and find out who are the people taking the decisions. Are those persons resident in India? If no, poem is presumed to be outside India. If those people are also outside India, or if they are not the people who are taking the call, it is assumed that poem is outside India. If they are resident of India, poem is in India. So this is the third step. This slide should be NABOI, not ABOI. Or else, first stage, identify person who actually the key management and commercial decisions of conduct are for conduct the company's business as a whole. Determine the place where these decisions are made. Primary factors where. So I'm sorry, this slide is actually the next slide. I've corrected it. We'll go to this 3.2. That is, uh, we have looked at in the previous slide what happens if there is active business outside India. There we have to look at the board of directors, where is it meeting, and so on. If not the board, who are the people calling the shots? Where do they meet? Now we come to the limb where it does not have active business outside India. Then it's straightforward. Identify the person who's actually the key management and commercial decisions for conduct of the business as a whole and determine the place where those decisions are made. So we straight away go to the key management body. That is, it could be board of directors or someone else. Identify those persons and identify the place where those decisions, the top decisions are being taken. Because it has most of the activities conducted in India. So that is why this stricter norm. We have to look at only the board of directors. Now, how do we decide where the decisions are being taken? That also has been given in the guidelines. Place where board meets regularly, provided the board retains and exercises its authority, not on paper, to govern the company, and does make the key management and commercial decisions necessary for the conduct of the company's business as a whole. Formal place may not be relevant if the decisions are taken elsewhere. So let's say the board of directors are meeting at Dubai all the time, but the minutes of the meeting do not show any crucial or uh, sort of top end decisions being taken there. Those decisions were taken elsewhere and being implemented throughout the enterprise or company. Then we need to find out beyond, go in substance. We ignore the form, we look at substance. Where are those decisions taken? So the formal place may not be relevant if the decisions are taken elsewhere. Delegated executive committee, place where that committee meets, is very important. Once the board has stepped aside, we have to look at who's the person taking the shot. Is it a committee or an individual? We have to look at that committee or the meetings if they happened. Where are those meetings being conducted of that executive committee? What happens if there are virtual meetings? In such cases, the place where persons taking the decisions or majority of them usually reside. The place of residence becomes important if normally all the meetings are being conducted virtually. So such a place may also be a relevant factor. If suppose the decisions are being taken by circulation, if the resolutions are being passed by circulation, determine the person who has the authority and who exercises the authority to take the decisions. Who is initiating those resolutions? Who is insisting that the resolutions be passed? Are the responses or objections being considered? Who's the person taking the final call? That person will become, or that group of people will become important in deciding if the resolutions are being taken by circulation. Shareholders' decisions, as we have understood, not relevant in the normal course. These affect the existence of the company itself or the rights of the shareholders rather than conduct of the company's business from a management or commercial perspective, and therefore generally not relevant for the determination of company's place of effective management unless the shareholders subsume the board's authority. So this is a very important phrase. This affects the existence of the company itself and or the rights of the shareholders. The shareholders' decisions, they don't impact the conduct of the company's business from a management or commercial perspective. That is the crucial phrase, and therefore generally are not relevant. However, the exception being if the board is only on paper and all the shots are being called by the shareholders, then that body of shareholders becomes relevant. Junior and middle management shall not be relevant for the purpose of POEM. Only the senior management is relevant. If all these factors, primary factors, in case of NABOI fail, only then we look at the secondary factors, which are places where main and substantial activity of the company is carried out, or place where accounting records of the company are kept. So the access to this secondary factors is not direct. It has to pass through those initial steps. And if all those steps fail, only then we have to look at the main and substantial activity or accounting records. Between these two, there's no law on this. I would take a stand that the first one would apply with greater force. The second would be still the last option. Few other pointers given in the circular 6. Poem is to be based on all relevant facts related to the management and control of the company and not isolated facts. We can't take each individual factor and look at it. So let's example could be there are 4 board of directors meetings taken conducted during a particular year. We look at the minutes of one meeting and decide, yeah, these were crucial for the conduct of the business. So where was this board meeting held? That could be one factor. If the other 3 are only sort of very usual board meetings without any crucial decisions being taken. But we cannot take in isolation one board minutes of one board meeting in isolation. We have to look at the entire years or activities as well as the board. It's only one example. We have to look at all the facts connected with that entity throughout the year. Examples are also being given in that. In that sense, this circular is really worthy of commendable because it has given a lot of illustrations, examples, and instances where poem may be triggered, where poem may not be triggered. So it's very welcome in that sense, and very unlike the usual circulars. The foreign company, and why? Because this, I'm told, is copy pasted from the South African guidelines. The principles, what we see in Circular 6, are sort of copied verbatim from the South African regulations. The examples, a foreign company is completely owned by an Indian company will not be conclusive evidence. 100% shareholding by an Indian company does not by itself trigger POEM. This has been clarified in the circular itself. Existence of a P in India would itself not be conclusive evidence that the conditions for establishing POEM has been satisfied. PE is only, as we understand, fixed place of business in the source country, which is sort of a juxtaposition of the parent company. So it's sort of a branch, or we have been given examples of physical PE, then we have service PE and agency PE. None of those PEs by itself will trigger POEM. That has been clarified here. Some of the directors of the foreign company reside in India will not be conclusive evidence. The place of residence of a director does not trigger POEM by itself. Local management being situated in India and activities being carried out by a foreign company in India will not by itself be conclusive evidence. The mere physical presence of the management in India or senior management positions in India will not trigger foreign POM unless supported by other factors. Existence in India of support functions that are preparatory and auxiliary will not be conclusive evidence. Back office work, all that if being conducted in or preparatory and auxiliary, which is a concept we have understood, if they are being carried out in India, that does not create POEM. To summarize what all we have understood, this is a flow chart. I couldn't actually draft it, so I took a picture and pasted here. Stage 1, 50 crore test, the threshold in terms of monetary, 50 crore turnover. If no, POEM need not be tested. It is a foreign enterprise, foreign company, not resident in India. If it is yes, if the turnover is exceeding 50 crores, then we come to stage 2. Classify F company whether engaged in active business outside India or not. So the test we have to evaluate is whether there is active business outside India or not. How do we determine that? There are 2 conditions broadly. Condition 1, income test. I'll use the laser pointer. So we are here to classify F company whether engaged in active business or not outside India or not. So for that, the factors are condition one, income test. Passive income has to be less than 50% of total income. Second test, asset test, less than 50% of total assets situated in India. That is, more than 50% or more assets should be outside India. 50% or more employees should be outside India. 50% or more of the salary expense should be in respect of employees employed outside India. So these are the additional three conditions. These are cumulative. It says and. So first condition has to be satisfied as well as one of the three of the second condition also has to be satisfied. For the purpose of above, evaluate the average of the date of previous year and two previous years prior to that year. So in all, 3 years average. If the answer is yes, if company has ABOI, activity based outside India. If no, there is NABOI, that is activities not having activities outside India. So that leads us to 3A. What happens if it is ABOI, that is activities based outside India? So what are the rules? Are majority board meetings held outside India? Yes, then we have to test further tests. If no, the place of effective management is in India. The moment the board of directors meetings in majority, that is, let's say 3 out of 4 meetings are being held in India, it is a resident company. If not, is the board standing aside? Although the board is meeting outside India, but it has stood aside and given up the powers. If it has not stood out aside, OM is assumed to be outside India. Why? Because the majority of the board meetings are happening outside India, and board is calling the shots. So it is not an Indian resident. The company is not a resident in India. If the board has stood aside, then we have to look at who are the people behind this. The secondary rule will. That was the primary rule. This is the secondary rule. Is decision making by holding company or persons resident in India? Yes. Place of effective management is India. The company will be resident in India. If not, it is a non-resident company. This was for activities, uh, business activities outside India. What if it has no activities outside India, business activities outside India? Step one, identify the persons who are actually making the key decisions. Step two, determine the place where these decisions were in fact being made. Factors relevant for POEM of NABOI, place of board meeting in substance. Because we are not sure who's the board, who's the people calling the shots. We have to look at in substance where those decisions are being made. If it is a delegate authority, location where decisions made by the delegatees or the committee members. Location of head office, place where the company's senior management and their direct support staff are located. So the registered office may not be relevant. Use of modern technology, place where decisions are usually, the decision makers usually reside. The place of residence of those decision makers will become relevant if it is virtual board meetings. Shareholders' decision not relevant unless involvement turns into effective management. They are being actively engaged in the top decision making, then shareholders' decision becomes the place where they take the decision becomes relevant. Secondary factors, main and substantial activity or accounting records. If none of these are satisfied, then we go to the activity per se. So this is how the entire circular can be summarized. So I've taken few examples just to apply those concepts which we have understood. So let's say there is one Singapore company engaged in trading of goods. It has earned the following incomes. Sale of goods, 40 crores. Sale proceeds of immobile properties, profit is 1 crore. The sale is 5 crores, profit is 1 crore. Sale proceeds of investments, profit is 2 crores, the turnover is 15 crores. Provision for expenses written back, 5 crores. Whether OEM is applicable. Any thoughts? We are trying to evaluate the threshold of 50 crores. Are we crossing the threshold of 50 crores or not? So the phrase used there is, I'll open that slide, turnover. Turnover of the foreign company should be more than 50 crores. So what do we mean by turnover? So there is no uh, clarification given anywhere, neither in the circular nor anywhere else. We have to fall back on the test which we use for tax audit purpose. 40A, the tax audit threshold, it has been understood through various judgments and so on that we do not look at sale proceeds of immobile property. That's not the business. That's not the turnover of the company, nor is the sale of investment. Sale of investment does not qualify as turnover. Provision of expenses written back, it's only reversal of an expenditure claimed earlier. So it is not turnover. Items second, third, and fourth are not turnovers. Only sale of goods can qualify as turnover. That being 40 crores will be less than 50 crores. And so we don't have to evaluate OM at all. It is a foreign enterprise, foreign company, non-resident foreign company. We'll move on to example 2. Company A is sourcing entity for an international Indian multinational group. It's an Indian multinational group which is having a company A which is incorporated outside India. It is a 100% subsidiary of Indian company B company. The warehouses and stock in them are the only assets of A company and are located in country X. All the employees of A company are also in country X. The average income wise breakup of the company's total income for 3 years is 30% of income is from transactions where purchases are made from parties which are non-associated enterprise and sold to associate enterprise. 30% of income is from transaction where purchases are made from associate enterprise and sold to associate enterprise. Third, 30% of income is from transactions where purchases are made from associate enterprise and sold to non-associate enterprise. And the balance 10% is by way of interest. So what is the passive income? 30% buying from third parties, selling to group companies. Second category, 30% buying from group companies, selling to group companies. Third category, buying from group company, selling to third parties. And interest, 10% is interest. And because it's a trading enterprise, interest by definition is passive. Now we have to look at the remaining 90%. If you want to have a look, the definition of passive income, the first clause, income from transactions where both the purchase and sale is from and to associate enterprise. So out of those three categories, only one, the second one, where both the buying and selling is happening from group companies, will get triggered as passive income. So 30% of this first and third category are not passive income. Those are active incomes. The second category is passive income, 30% plus 10%, 40%. It being less than 50%, we don't cross the primary test, the first test itself. We don't have to go to the second test. Interpretation, passive income is 40% of the total income, namely 30% of group transactions, both buying and selling, and 10% of interest. A company satisfies the first requirement of the test of active business outside India. ABOI test, the first one, is less than 50%, so it qualifies there. Since no assets or employees are in India, the other tests are also satisfied. Therefore, the company is engaged in active business outside India. So as you remember, the first test is passive income. Second test, any one of those three. Those also not being satisfied. So it is resident outside India. Third example, a foreign company has following incomes. Gross receipts from active. Now, this is a complication. This is not from the guide, circular. Gross receipts from active business, $10,000 million. There is a loss on that business, 300. Gross receipts from passive business, 500. Royalty, dividends, interest, 500. So net income is also 500. There's no expenditure related to this passive income. So what happens? My overall net profit becomes 500 minus 300, 200. How do we apply the test of 50%? Whether if company is engaged in activities, active business outside India or not. If you see the turnover, it is $10,000 million, but it has incurred a loss of 300 million. And because of that, this netting off, the net income is 200. Now the formula tells us you have to adopt 200 to evaluate whether it is 50% or not. So this loss being less than 50% of this total income, if we read the guidelines as is, it would definitely trigger the first test. Guidelines follow if company's domestic law. What the guidelines say is you follow for determining what is the income, you follow the domestic law of that country. And usually it would be income. Can gross be considered? That is a $1 million question, $1 billion question. It is not yet decided. It is open to interpretation. What recourse we can take is to that judgments based on the export incentives under 10A, 10B, 80HC, where it says that the numerator and the denominator have to be same units. Here, what is happening? This is a plus figure, this is a minus figure. So this does not become comparable. What we need to compare is the turnover. 10,000 plus 500 becomes 10,500. 10,000 above 10,500 is more than 50% outside India. So I should be able to come out of that trigger of uh, business activity being in India. If we follow in letter, it becomes, it satisfies that 50%. It does not satisfy that 50% threshold, and it could trigger POEM. But in my view, we should look at uh, these judgments to look take the gross turnovers and not the income. Although the guidelines, and mind you, it's a guideline, right? Principles of in the matter of guidelines. And again, we are using substance over form. What the department has been telling us to follow, we are also doing that, right? When I'm, so imagine the entire P&L account is, top line is 10,500. The bottom line is 200. My entire activity is outside India. How can merely a formula determine my residency in India? Similarly, what happens if there is a profit? Let's say 10,000 is the net income, 500 is the net income. Let's change the facts. 10,500 is the total income, but in that source country, in the country of incorporation, 10,000 is exempt. So it doesn't form part, to take our equivalent example, it doesn't form part of the total income. The total income is 500. 500 upon 500, 100% is passive income. Does it mean that I do not have active business outside India? Definitely not. That is another instance where this guidelines will fail. We will have to look at the substance. In substance, there is a huge activity which is being carried outside India, and that should be given due credence. What happens if we trigger the place of effective management test for the very first time? So what happens? A foreign company becomes a resident of India. So as you know, the first repercussion is all global income of that foreign company will be taxed in India. It will not enjoy the benefit of Indian company because the lower rate of tax is restricted to a Indian company. It still remains a foreign company which is resident in India. So the higher rate of tax will apply, 40% plus surcharge plus cess. So apart from that, there could be cases where that foreign company has brought forward losses, exemptions, and so on. What happens to that unabsorbed depreciation? So for that, a notification has been issued, notification number 29, 2018. It says if a company is resident in India on account of POEM being in India for the first time, then notwithstanding anything contained in the Act, the provisions of this Act, that is Indian Income Tax Act, because that is what we have to read now. Once the foreign company becomes a resident of India, it would be governed by the Indian Income Tax Act provisions. So those provisions will be modified to the extent mentioned in notification 29. It's a very elaborate notification. I have just given a gist here. The computation of income will have to be followed based on this notification. Treatment of unabsorbed depreciation also is altered by this notification. Set off and carry forward of losses, collection recovery proceedings, special provisions relating to avoidance of tax shall apply to the foreign company with exceptions, modifications, and adaptations specified in the said notification. That was all from my side. Thank you all for your patient hearing.
Thank you, Nilesh sir, for the riveting session. It was, I think, the more the steps we had to count, how many steps we have to take for each ascertaining. Like even after doing ABOI, we still have further steps. It doesn't stop at ABOI. So I think we'll move on to the question answers. We have quite a few. So the first question is, can it be argued by the department that a company has POEM in India if it is a company registered and located in UAE with 100% shares held by person resident under income tax in India and with no director, but only one employee who is fully authorized to run the company, and such employee is holding Indian passport but is a non-resident under the Income Tax Act?
I think we have covered this point already.
Yes.
Shareholders do not determine the place of effective management. As you in your facts, which the person has pointed out, there is a person who has been appointed and is operating there. So what we need to look at is whether it's only the day-to-day activities of that enterprise, or is he taking the top management decisions that is to be evaluated. Once it is established that he's the person who is actually calling all the shots of how to grow the business, how to raise funds, how to deploy funds, those parameters. And apart from day to day, so we don't look at the day to day, but what is the top end decisions like investment decisions, branching out, expansion business. If those decisions are always consistently taken by him without any guidance or without any sort of prompting from the Indian directors or shareholders, it should be non-resident.
And even if they are, so if the shareholder is the person who is taking the decisions and he's a resident, then obviously that will trigger a POEM.
Yes, that would.
Yes. Yeah. Second question, where total income earned in India exceeds 15 lakhs, whether global income is taxable in India? I think this is for a resident individual.
Yes. So once you cross the threshold of 15 lakhs and you satisfy those conditions, you become a resident. Once you become a resident, global income will get taxed. You may get tax credit under the DTA if it is available. Otherwise, global taxation will trigger.
Which section will apply for LLP?
LLP.
Residential, yes. I think in that
So
residential.
Yes, if it is Indian LLP, by definition, it's a resident of India. So outside India, it's more prevalent is LLC. So we'll have to test the LLC act of that country. So let's say it's a LLC incorporated in the US. We'll have to read the US legislation on LLC, whether it treats it as a body corporate or not. If it treats it as a body corporate, it falls under 6(3). Otherwise, it might come under others because it's not a firm. Only Indian LLPs are by definition firm. Uh, Otherwise, it goes under 6(4). You'll have to see control and management, not POEM.
So even this one member company in LLC, which is incorporated in US, that also we follow the same.
Yes, we'll have to look at the status there, whether it's called a body corporate or not.
Okay. Okay. So the next question is section 6.6 has a concept of not ordinary resident. However, the provisions of TDS on non-resident and residents are provided in Chapter 17, including certification for TDS at lower rates under Section 197, where Chapter 17 is completely silent regarding rates applicable to NOR. And there is also no provision to apply for lower rate of TDS to NOR. So my query is, what should be the status of an NOR while deducting TDS on a payment to such person? This is especially arising in the case of sale of immobile property by a NOR, not ordinary resident.
I'm not wrong, non-resident, not ordinary resident is considered as a resident for the purposes of compliances of the Act, compliances under the Act. So
Okay.
all the provisions relevant to residents will apply to NOR as well.
Okay. So he can still, if required, he can still apply for lower deduction.
Lower rate.
Take it. Can a person be considered as resident in India under Section 6(1)(a) if his or her income from India exceeds 15 lakh rupees and he is resident in a country where his income in that country is lower than the minimum taxable threshold in that country, and therefore it's not liable to tax in any other country or territory by reason of his or her domicile or residence or any other criteria of similar nature. So in India, it is exceeding 15 lakh rupees. And in that country, in the country of domicile, it is below the threshold. That's what.
Yes. So the clause is saying that it will apply only when he is not a resident of that country. So this clause was inserted only to plug the case of double non-deduction.
Correct.
That is, a person is not a resident of India nor the place where he usually resides. He is a non-resident at both the places, and so the entire income gets scot-free. So the double non-deduction was a sort of a tax abuse. To plug that, they have brought in this. Once you satisfy the test of being a resident of that foreign company, these clause of Section 6(1)(a) will not apply.
Not apply. Correct. What if decisions are taken virtually? I think this you have addressed in the Circular 6 of 2017. So it will depend on the place where the person is residing or the residency of the person who is taking the calls on the virtual meetings. A US citizen, PIO, after 15 years of stay in US, came and settled in India from July 23. So it is about 243 days in India. He works from India and gets his salary credited to US account and works for US company. Being US citizen, he is liable to pay tax in US, and the same is credited to his US account. He also gets his rental income from US property credited to US account, bank account. His first year status will be RNOR. Is he liable for taxation in India on this salary?
Yes, definitely yes. Not only on salary, I would say a global income if he satisfies the tiebreaker test. We'll have to go to the USDTA and apply the tiebreaker test. Finally, which country gets the right to tax him as a resident? If it is the India gets the right to tax him as an Indian resident, then global income would be taxed in India.
You can take foreign tax credit.
Yeah, I
Whatever
understand
he is
that
paying
US
in
has US has that citizen-based taxation system.
Yes,
So
sir. Yes.
in these facts, it appears that it could be a resident of both the countries at the initial stage. That's why the tiebreaker test is important.
Oh. So, sir, there was now with the TRC being in place. So any foreign country, for anything we ask for the TRC. That is the standard requirement to ascertain which country they are a resident of. Now, with that being in place and many cases support TRC should be considered to be a valid document, and you should not literally go behind the corporate veil. So how can POEM balance with TRC now? Is it TRC is no longer held as a standard document? I understand.
So I presume this is your question, right?
Yes, sir.
So
Yes, sir.
yeah, brilliant. TRC is definitely a certificate only to the extent I would read it as only to the extent of obtaining while doing TDS at the time of when the payer is making a payment to the recipient who is outside India. The TRC would apply to that extent. the person liable to deduct tax cannot be held responsible if there is a TRC. So I think the purpose is that. And of course, if OM would prevail over that TRC is my call. Again, it has to be tested because OM is a fundamental concept where we are testing the residency, and it has to be tested on based on various facts which go
So
much beyond,
even if I have to, okay.
yeah, which
Yes,
go
sir,
much
please, sir.
beyond, yeah. So the concept of poem is very subjective, first of all. It cannot restrict itself by just producing a TRC. That would actually undo the entire process concept of poem, and definitely that's not the intention. So poem travels much beyond that. Poem will prevail over TRC, is my
Hmm.
call. I think Mr. Singh is the right person to
Sir.
answer this one.
In fact, if you look at the purpose of TRC and the purpose of the criteria for deciding the residential status in India are two things. The TRC gives the residential status in the other country. We have to also see, I mean, according to our domestic law, whether a person is a resident or not. So he says, I mean, the TRC normally it presumed that the person is a non-resident in India, and then we ask that if you want to avail the benefit of the DTA, show me your TRC. But if it is established that he is a person who is a resident in India, then whether the tiebreaker rule has to be applied or not, for that TRC will become relevant. So these are the two things, two documents for different purposes, but they converge when the person becomes a resident in two countries.
Correct. Okay.
Thank you, sir.
Okay. But also it was interesting to know that South Africa already has the poem regulations, which you said that it was same as what is we have in the Circular 6 of 2017 with all the examples. So that
Yeah.
was really an interesting fact that was not known. So, and there was a case law which you told that, I mean, which you also referred to in one of study in one of your examples, that where a company or the director has a agent who has the rights to who has been given the rights to act on behalf and with the same footing as the director who has come to India. So would that principle still hold? Can we extrapolate it to a HUF where a karta also does that, to say that this one place of management is outside India because my agent who is not dependent on me for taking decisions is taking decisions, but would that somewhere work?
In my mind, not as much, because under corporate structure, there is delegation of powers, there is documentation, and there is a process followed to delegate. So it may be very difficult to take the same stand here under an HUF. HUF is a one-man show, right? So if it is a passive income, let's say a rental income, so I may deploy a person to give a GPA and execute all the lease deeds, renewals, and enhancements, collection, and all that. Probably, if we can have such documentation, chance that it can be taken recourse because it is talking of control and management.
Yeah, yes,
So
yes,
a
yes.
lower threshold than poem, right?
Okay. So we have one more question. Company A has, Company A, 100% subsidiary of Indian company, engaged in the business of manufacturing and sale in Europe, has 4 directors, of which one is Indian, other is NRI based out of UK, and balance 2 are from Europe. All the meetings are held in Europe, which are chaired by the Indian resident who also has unlimited powers. Whether the local directors having only administrative powers, whereas the local directors have only administrative powers. Will the poem get triggered if the active business outside India is more than 50 crores?
So here we have to see the location where the board of directors meetings happen. If those are happening in the Europe, I think we are safe. But if those are majority of them are happening in India, all of those 3 directors travel to India and all the decisions are taken here in India, definitely poem will get triggered. It would become expose itself to residents in India. If it's somewhere in between, probably we'll have to look at and of course, this board of directors would be step 3. We have to follow
Yes.
step 2 as well. the passive income activities outside India, 50% of in assets, employees, and salary outside India. If those tests are met, those are objective tests. So we have to evaluate all of those stepwise.
Okay. Okay, sir. Sir, will the transfer pricing documentation have any relevance for poem determination, or will it have any significance or any takeaway while determining poem?
So it is another fact pattern, I would say. That we have FAR analysis in the transfer pricing documentation.
Yes.
If something comes up there which shows that the see, here we are evaluating the decision-making powers.
Correct.
From the FAR analysis, I don't see that coming out. But if suppose assets are deployed, so it could be useful in the analysis of assets being deployed in India, outside India, something of those sorts. But decision-making powers, if it comes to test three, step three, where we are evaluating whether the board of directors meeting is happening in India or not, there it may not be relevant. But definitely to evaluate the inter-group transfers, whether it is to be treated as passive income or not, in those aspects, definitely the transfer pricing documentation will be helpful.
So,
In fact,
how are-
in fact, when you look at the transfer pricing and PE, or obviously, I mean, the residential status, they go in the opposite directions. If you want to reduce the risk from transfer pricing and try to say that an Indian entity is not doing anything, not taking any decision, then the risk of the other entity getting taxed in India becomes more and more. That becomes significant. So these two things go in the opposite directions. So if you want to, you have to be very, very careful when looking at because if you should not create, a taxable entity of the foreign company in India.
in India?
Yeah.
So we can say, sir, then if suppose there's a poem trigger and the foreign company is deemed to be a resident domestic company, and if the let's say documentation speaks otherwise, then there could be transfer pricing problems, right?
There could be transfer pricing.
Yeah.
Yes.
So this now this place of effective management, or even understanding wholly and the key management decisions or commercial decisions are all very subjective. So how deep should one go to understand this, or even to mitigate the risk, to document it or to advise on this? How deep should one go as an advisor, as a chartered accountant, when we are advising or when we are looking into the provisions?
So first and foremost, make sure that the majority of board of directors meeting happen outside India. That's the first requirement. Then probably the minutes would be an indicator. What sort of decisions are being taken at those meetings? Is it the routine types, and whether those decisions are being actually implemented? Or is it something else, that the center of power is elsewhere and those decisions, his or her decisions, are being put in action rather than the quality of the decisions taken? Are they the top supervisory and commanding top types or not, like fundamental to the business or growth of the business and so on? If that is put in place and it is supported by numerous evidences of activities being carried outside India, if let's say it's a a passive income sort of a thing, then we'll have difficulty in establishing whether actually the board of directors meeting holds sway over the facts. So it's highly fact driven. We have to look at a 360-degree view. As the circle itself says, that we can't take one aspect in isolation. A complete picture has to be looked at, and over a period of time, the entire year, not at any time. So the reason why that phrase was dropped was to evaluate throughout the year, starting 1st April till 31st March, the whole year. If we see in a bird's eye view, what has happened at the company at the top level, who was calling the shots, who was taking the final decisions, where were the activities actually being carried out, whether those decisions, where those were being taken and implemented, by whom. So all these fact patterns will have to be looked at. There is no straightjacket answer what could be useful as a evidence. Time will tell. Once we evolve, there could be nuances here and there. But broadly, I think look at the top management. Where is it sitting? What are the decisions taken?
The other aspect which need to be considered and which become very important in transfer pricing also is the line of control. Where is the employees? I mean, to whom are they reporting? Who is the appointing authority, or who determines the pay scale and all those things? So those are the factual metrics, as Nilesh has rightly said, that the factual metrics need to be seen. I mean, there is no one formula which will be applicable across the board. So each entity, each one has different facts. So each fact has to be seen separately.
So ideally, we start with the active business outside India. If we are seeing it as a post-mortem, do we start with ABOI, then go to board meetings and all that, then if doesn't that satisfied, then we go to NABOI.
Correct. Even that
Right, sir?
guidelines are saying that.
Same thing.
Yeah, yeah.
So there is a fixed pattern in how you have to start looking at it one by one.
Yes, that structure
Yes.
is given. So thankfully, we are clear on that, how to
Yes.
approach evaluation.
Yes. And this, when we are calculating that passive income, that the previous 3 years data that we have, I mean, that has to be seen. So that has to be seen from the foreign companies accounting year point of view, sir, or how is it? Or it has to be redrawn to Indian April to March and seen. If we see in
We
one of the criteria, that was the 30%, the less than 50% should be in India, that part. So we
Yes.
have yes, sir, accounting
So
years.
we'll have to evaluate based on the previous year as defined in the Indian income tax act. So it has to be financial year, 1st April to
Okay.
31st March. If the foreign
Okay.
enterprise has a different accounting year, we'll have to redraw them to the financial year. We do that even for consolidation, right? So for
Yes, sir.
for company law compliances, we do that. So the
Yes.
same has to be done even for income tax.
Okay. Great, sir. I think we have completed all the questions. Sir, anything is missing, sir?
No, I would like to thank Nilesh for really very, very nice presentation. And the beautiful aspect is that of his presentation is that instead of talking only theory, he has come out with examples and divided in a step format, and then given the summary at the end, so that one can and the presentation would be available for the attendees to look at, and they must listen to that, because there are certain finer points which must be taken into account, which Nilesh has discussed, has elaborated, but are bound to be missed, I mean, when you are looking at a bigger picture. So one need to look at very finer points, and that's the way, I mean, a presentation should be. And thanks to Nilesh for coming up with a nice presentation and addressing all the questions. I mean, there is no question which has been unanswered, so which is a big factor, I mean, for satisfaction of the listeners. And thanks to you, Bhamini, I mean, nicely, I mean, conducted this, and that shows your knowledge of international taxation at the same time. Thanks to you, thanks to Nilesh for such a nice presentation. I'm sure attendees must have been very, very benefited, and they would be looking forward to next presentation by you. Thank you.
Thank you.
Thanks, Nilesh. Thanks,
Thank
Bhamini.
Thank you,
very
Singh sir,
much, sir.
for a wonderful feedback and sharing this session. Thank you, sir.
My privilege.
Thank you,
Bye.
Nilesh, sir, for taking us through this nitty-gritties of poem and the residency concepts, and delivering this in a timely manner, and also addressing all the participants' questions, including mine. Thank you so much. On behalf of the Direct Tax Committee and all the members present here, I would like to thank you for your time and also sharing your knowledge and expertise with us. I would also like to thank SP Singh sir for his guidance, insights, and thoughts on today's topic. Thank you so much, sir.
Thank you.
Thank you, sir. Bye.
Okay.
Thanks.
Yeah, please. Thank you. Same to you. Bye.
Bye.
Thank you.